Okay, good morning, everybody. So welcome to our 2018 results. Thanks, everyone, for coming. So what I'll go through is I'm going to give a little bit of an introduction, talk a bit about our purpose and how our strategy flows from that. Then go through an operations and business review of the year, hand it over to Andy Skelton. Welcome, Andy, our CFO, who's here for his first set of results, of which he's only been able to prepare, no impact on creating them, having started on January 1st. And then I'll come back and do an update on our strategy at the end. So the acquisition of the Scottish power assets that we completed at the beginning of this year, I think, has really brought our purpose as a company very much into focus, which is to enable a zero-carbon, lower-cost energy future. And let me describe to you what I mean by that. So during the course of 2018, there were several reports that were issued that described what were the pathways that we might use to get to a world that only would warm by 1.5 or 2 degrees. All of them start with electrification as a sort of key part of the puzzle. And just to give you one thought, I saw a McKinsey report last week that noted that the demand for electricity is growing 7 times faster than the demand for other forms of power globally. Right? The second thing in those pathways is that the electricity mix would be very much dominated over time by wind and by solar. Right? And again, in that same McKinsey report, they noted that actually in pretty much every market now globally, the lowest cost form of energy is wind or solar power. Right? But at the end of the day, if you have a system that is, let's say, gets to 75 or 85% intermittent renewables, there still needs to be another source of power that actually supports that system and that actually is dispatchable as opposed to intermittent. Right? And I believe very strongly that biomass has an important long-term role to play there, as does hydro, and as does gas, if maybe gas on an interim basis. Although I guess interim in this context is probably the next 30-plus years. Right? So if you think about all that and you say, what is our role? I think our strategy is clear. And it all links back to that purpose. And effectively, we want to be there to support the system when the wind is not blowing and when the sun is not shining. And I again believe that we have very attractive opportunities to deliver strong returns for our shareholders by delivering that purpose. So if you look at Drax in 2019, it really reflects what's been over the last decade a very significant transformation. Right? So again, it's no longer about coal. I mean, last year we generated 75% of our power using biomass relative to 25% using coal. But we're now not just biomass, but we're also gas, and we're also hydro, we're also pumped storage. We're a leading provider of dispatchable power. We're the 3rd largest generator now in the UK, able to generate enough power for about 13 million homes. And not only do we have the assets we have today, but we have a great portfolio of opportunities to do more. We're also no longer just about generation. We're obviously a very significant retail player. Right? We are the 5th largest business-to-business supplier in the UK. We're the leading challenger brand. And as the world, or as the UK moves to a world of smart meters, we see a very significant opportunity to play there. Right? If we can be a low-cost provider offering differentiated propositions, we think there's a very good opportunity in that business-to-business space, and we are investing to deliver that. And the final point I would make is that we think that there's a very significant long-term opportunity for biomass. Right? And there are really 3 pieces here. One is it supports the forest. So contrary, I think, to what would be many people's immediate reaction, actually providing an economic outlet for a significant piece of sort of the residues or the byproducts that come out of the forest, biomass is key to sustaining healthy forests. And we only will operate in places where that's absolutely the case. Second point is that it's a low-carbon form of system support. And again, as I said before, that's an unusual thing that we can do there. And the third point is that biomass has the unusual capability of potentially providing negative emissions. Right? By using bioenergy with carbon capture and storage, or BECCS, effectively there's an opportunity to be a source of negative emissions, which again is an unusual position for us to be in. Right? Now there's a lot of work we need to do to get there. First, we obviously need to bring the cost of biomass down so that it is viable without government support, and we're working hard to do that. And clearly, again, there needs to be a framework put in place for BECS to work as well, and I'll talk more about that later on. But again, I think fundamentally we think this works as a business strategy. We think we can generate attractive returns. And ultimately, again, in this context, how we allocate capital will be a key issue for us. So now let me talk a little bit about 2018. So in short, I think it was a year of some significant challenges for us. We had significant outages on our biomass generation units in the first quarter. There have been the legal challenges to the capacity market, which Andy will talk more about the financial impact of that. There was the mutualization of significant costs in the retail market, whether that was the cost of the ROC obligations of various failed suppliers or the cost of an unidentified gas. But in that context, I think we did a pretty good job. We had good financial performance with 250 million of EBITDA, very much in line with market expectations. We delivered 311 million pounds of net cash flow from operating activities. And we delivered strong cash returns for our shareholders, completing a 50 million pound buyback, and today announcing or confirming our dividend, which is a 15% dividend per share growth. Right? And ultimately, we also completed quite an attractive acquisition. So I think a very good year for Drax as a group. So again, I think it's important to reiterate that safety, sustainability, and good governance are very much at the core of what we do. We continue to have a very good safety performance, although I always think that there's more we can do, and we continue to be focused on doing the best we can every day to make sure everyone gets home in the same condition that they come to work. It's especially true with regards to biomass. I mean, as you all know, biomass, it's a relatively new generation technology, and we're always looking for ways to make sure that we're operating as safely as we possibly can be. The only other point I would make here again is that our biomass is fundamentally sustainable. That is absolutely central to what we do. If that were not the case, the whole story that I've laid out for you would not work. And we must be, and we are, contributing to healthy and growing forests, and we continue to have initiatives to ensure that that's always the case. I wanted to talk briefly about the capacity market. I'm not sure I have a lot to add to what you probably already know, but we continue to work closely with the industry, with Energy UK and with BEIS to make sure we understand how this is going, and we make sure that I think the government is aware of the urgency that we see in this issue being resolved. We continue to expect that the market will be reinstated in a form very much similar to what was there before. I think the European Commission's announcement last week that they've commenced a formal investigation to sort of move the process forward is very much in line with that. And the actual opening decision that sits behind that, we expect to see shortly, and would again expect it to confirm that the approach that we're expecting from them. On the flip side, I think the industry has gone through a lot of work to try to put in place a mechanism that would allow cash to continue to be collected from suppliers and be ultimately made available to generators when the system is reinstated. So we were disappointed that Ofgem didn't support that initiative, although there is another option that is still under consideration. Final point I would make is that I think in determining sort of the latest update to the retail price cap, I think it's important to note that capacity payments were sort of included in those calculations. So we again believe it's very much in the government's intent that the system is sort of reinstated, right? And that's the operating assumption that we're using. So turning to our three different businesses. So as you all know, the first quarter for our generation business was difficult, but we then delivered, I think, quite strong performance through the rest of the year. Right? So for example, our CFD was available, or had 97% availability across the year, which again is very strong performance. As you know, we converted our fourth unit to biomass in the late summer, and as a result of that, we had about a 6% increase in our overall renewable power generation, and now last year delivered 12% of the UK's renewable power. And again, we see growing opportunities for us to support the system. I'll give you a couple of examples. So the overall cost of balancing the system in the UK has grown from about £500 million per year in 2010 to about 1.2 billion last year. And that sort of market, if you will, is really where a lot of our assets will over time operate, sort of increasingly operate. So for example, Cruachan, the pump storage facility that came with the acquisition we made, is very much involved in that market, and that's where they get a lot of their earnings. And that's, again, since we've acquired them, we're seeing sort of very attractive opportunities for us to support the system within that marketplace. Right? The other point I would make is that we now have a very much a national and balanced portfolio of generation assets. So multiple technologies, lots of different locations. The technologies can operate to support each other. So for example, if one of our units is not running, we can often pick up that position with another unit. And importantly also, we're able to support the system really from the top to the bottom, from Scotland all the way down to Brighton, and importantly also around London. So we see lots of opportunities for us there. So our pellet production business in the U.S. had a very good year. It was really driven by the commissioning of our third pellet plant called LaSalle Bioenergy. We now have 1.5 million tons of capacity. We increased our pellet production by 64% to about 1.3 million tons. We actually reduced our cost per pellet by 10%. And ultimately, this business contributed about 21 million to the EBITDA of the group, which is up from 6 million in the prior year. Right? So the pellet production, this is a key part of our strategy, as you know. I'll talk more about it later, but delivering sort of good quality, low-cost pellets is core to our ability to make biomass viable ultimately in the long term. And so very pleased that our U.S. pellet production business is doing very well. Turning to the B2B energy supply business, I would say 2018 was a difficult year in this marketplace. As I mentioned before, there were external regulatory factors that were challenging, so ranging from the rock neutralization, which I think you all know about, or we can talk more about, also the challenges of an unidentified gas. Right? There were other issues that were more specific to us. We had a difficult year managing our bad debt expenses. Some of our customers had their challenges. I would say that since the half year, we put lots of effort into tackling those issues. Andy, again, will talk more about it. And I think this is probably not the kind of challenge that's ever going to be completely solved. We always have to be very vigilant here, but I think we're in a significantly better place now than we were at the half year. I would say for me, more importantly, in some ways, on an underlying basis, the business continues to grow strongly. We increased our meter count to 396,000. We increased the gross profit in the business to 143 million. So the core drivers behind the Opus business that we acquired now a couple of years ago are very much sound and continue to do very well. Right? And the other thing that's now starting to come more into view is the opportunity that we think is going to be there as we actually move into a smart meter enabled world. Right? So we have more data about our customers. There's lots more that we can do. So we are investing in systems to enable us to be a low-cost provider from a strategic positioning. We think that's very important, but also that will enable us to offer differentiated propositions for our customers. And we think there's a real interesting opportunity for us there. And with that, I will turn it back over to Andy.
Okay, thanks, Will, and good morning, everyone. I'll now walk you through the financial review for the full year. So starting with the financial highlights on slide 13. The adjusted EBITDA of 250 million grew 9% in the year. It represents a good performance in line with expectations, and this despite the challenges of the restricted biomass generation in the first quarter and suspension of the UK capacity market during the fourth quarter. The suspension of the capacity market had a 7 million impact on EBITDA as we continued to accrue all the costs in the energy supply business, but we did not accrue any revenue in generation. The business continues to be strongly cash generative. We had net cash from operating activities of 311 million. After capital investments, after increased returns to shareholders, and after servicing of debt, our closing cash was 289 million, and our closing net debt was 319 million. This represents a net debt to EBITDA ratio of 1.3 times, and that's ahead of the previous guidance of around 1.5 times. The acquisition of Scottish Power Generation was completed on the 31st of December, with net consideration of 687 million, and that excludes transaction costs. It was cash settled on the 2nd of January. The net consideration was 15 million lower than the gross purchase price of 702 million, and that reflects customary sale and purchase agreement adjustments, primarily in reflection of working capital. Subject to the outcome of the European Commission's review of the UK capacity market and re-establishment of the scheme, we're targeting a net debt to EBITDA ratio of around 2 times for 2019. The board has proposed a final dividend of 8.5 pence per share, given a full-year dividend of 14.1 pence per share. This represents a 15% year-on-year increase on a pence per share basis. The total cost of 56 million is in line with our previous guidance. We believe that this level of dividend is sustainable through the business cycle, and we expect it can increase further over time as our strategy delivers higher future levels of EBITDA and cash. The £50 million share buyback programme that we commenced in April is now complete. In total, we bought back 13.8 million shares at an average price of £3.61. So moving on to slide 14, we'll look at other income statement highlights. So following the adoption of IFRS 9, we've elected to present the income statement in a 3-column format. Adjusted results are stated after exceptional items and after certain remeasurements. For the rest of my presentation, all the references will be to these adjusted numbers. For 2018, the exceptional items include acquisition and restructuring costs, primarily in respect of the Scottish Power Generation acquisition. They include asset obsolescence charges, which reflect the write-off of coal-specific assets following the conversion of the 4th biomass unit, and they reflect debt restructuring costs. The remeasurements relate to the impact of fair value accounting gains and losses on derivative contracts that are not designated into hedge relationships for accounting purposes. This change in presentation has had no impact on our presentation of EBITDA, and it continues to be a non-statutory measure. I'll walk through a bridge of the year-on-year EBITDA movements on the next slide. Revenue has grown in each of the business units. In pellet production, the growth primarily reflects the commissioning of a 3rd facility in LaSalle early in the year. In energy supply, the number of customer meters grew by 5%, and there was a full year's revenue from Opus Energy. In generation, I'd highlight an increasing proportion of non-commodity price exposed earnings in the year. The net finance costs include 40 million of interest charges compared to 32 million in the prior year. The 8 million increase represents a full year of servicing debt associated with the Opus acquisition and other costs associated with working capital facilities. The tax credit of 5 million arises from the benefit of UK patent box claims. Under the patent box regime, we get a 10% tax rate on income related to our biomass activities. And as such, we continue to expect that this will have a positive impact on our effective tax rate through to 2027. The profit after tax of 42 million compares with 3 million in the prior year, and it represents an adjusted basic earnings per share of 10.4 pence. That compares with 0.7 pence in the prior year. So moving on to look at a year-on-year bridge of EBITDA. EBITDA grew 9% to 250 million in the year. In the US, the pellet production was strong, with a 64% increase in volumes of wood pellets produced. This is a primary driver behind the 15 million year-on-year increase. The cost of sales in the pellet production mainly consist of fibre procurement, transportation, and of processing. The impact of increased volumes and process improvements has reduced the cost per tonne by 10% year-on-year. This is a significant achievement. Continuing to deliver further improvements in the cost of producing pellets is a key area of focus and a significant opportunity to deliver further EBITDA improvements. The EBITDA from power generation decreased 6 million in the year. As noted, this is a good performance considering the reduced biomass generation in the first quarter and the UK government suspension of the capacity market. Overall, EBITDA for the biomass generation grew despite the negative impact of the 2 unplanned outages in the first quarter. It reflects 91% availability in the year across units 1 to 3, with Unit 1 achieving 97%. With the successful low-cost conversion of the 4th unit, output across the biomass units increased 6%. This also created a benefit from a reduced amount of EU carbon permits required to support coal generation. We also continued to focus on optimization of rock generation, biomass operations, and the procurement of third-party biomass volumes. We also benefited from higher rock prices, which supported better bark spreads. The reduced EBITDA in the coal generation business reflects a 35% reduction in output from the coal units as commodity prices increased. It also reflects a decrease in ancillary services related to a specific one-year black start contract that contributed 10 million in 2017. Despite the 7 million negative impact on EBITDA of the capacity market suspension, our income from the capacity payments grew 5 million during the year. So moving to energy supply, EBITDA of 28 million was 1 million lower in the year, and it reflects a number of offsetting impacts. Firstly, the gross profit grew 26 million or 22%, and this reflects a 5% growth in the customer meters and the inclusion of Opus for the full year. This increase in gross profit, as Will noted, is after bearing additional costs for mutualisation of renewable obligations that are associated with competitor failure, and also higher gas costs due to weather and mutualisation. The total bad debt expense in the year of 31 million grew 13 million and can be attributed in a large part to the challenging operating environment that our customers are facing. At the end of the year, it's worth noting that our balance sheet provisions of 44 million are 16 million higher than the end of 2017. We continue to focus very strongly on managing our bad debt experience. It starts with the customer acquisition process, and it continues with the management of debt throughout the collection cycle. We involve third-party collection services where appropriate. We've increased our use of credit insurance to manage this exposure, and we have access to attractively priced non-recourse receivables facilities. Going forward, we think the continued rollout of smart meters will also help. The energy supply business continues to invest in next-generation systems, both to improve efficiency and to reduce cost, but also to address opportunities for further growth that are created in the smart meter world. The increase in OPEX during the year reflects inclusion of Opus for the full year, but an expansion of our cost base to manage the increase in customer numbers. Once these systems are in place, we'll be able to scale our operations more efficiently in the future. Now turning to the next slide to look at a year-on-year bridge of net debt. As noted, we delivered 300 million of net operating cash flow in the year, and this was helped by a working capital inflow of over 100 million. The working capital inflow reflects three things: an inflow from inventories, where December 2017 was a high point following the rail unloading incident; an inflow from payables, as we continue to focus on optimizing our commercial terms for the long run and use working capital efficient payment facilities in the short term; and an outflow as we held increased levels of ROCs at the year end following conversion of Unit 4 to biomass. Through strong cash generation, we've funded significant capital investment, and I'll talk more about that shortly. We've returned in excess of 100 million to shareholders through dividends and a share buyback, and we've covered all of our debt servicing costs. In so doing, we've maintained a strong balance sheet, reducing net debt by 48 million and our net debt to EBITDA ratio from 1.6 times to 1.3 times. So looking a little more on capital investments. Our capital expenditure in the year totaled 142 million. Within that, maintenance spend of 55 million is in line with our guidance. and we continue to expect that maintenance will average 50 to 60 million per annum going forward. Not all of the maintenance is an annual spend, some of it is periodic, so it will move in that range. In 2019, there are 2 planned outages, so we expect the maintenance spend to be at the top end of the range. In enhancement projects, we spent 40 million. This includes the investment in the energy supply business in those next generation systems, and it also includes development of a new rail spur at LaSalle. We expect the new rail spur will reduce transportation costs by over $10 a tonne once it's fully commissioned. In 2019, we'll continue to invest in next generation systems for our energy supply business, and we'll undertake the first of a 3-unit, 3-year turbine upgrade program with Siemens, where we know that modest improvements to efficiency will deliver a fast payback. On strategic investments in 2018, it included the conversion of the 4th biomass unit and incremental investment in the development of options for new gas generation. We now have 2 OCGTs ready for when the capacity market is re-established, and we've begun some site preparatory work in respect of the repowering project. In 2019, we'll continue to develop those options for new gas generation, subject to the reinstatement of the capacity market, and we'll invest in expansion of pellet production capacity to support operational efficiency and cost reduction. And this is part of our aim of meeting 30% of our biomass requirements from self-supply. Included within the other of 12 million is 9 million for the purchases of capital spares. As I noted earlier, availability is a significant driver of delivering continued operating performance. And this increased holding of capital spares is part of ensuring we're able to deal with outages in the most efficient way. In 2019, we expect other CapEx to be in the 5 to 10 million range. So altogether, if you include 30 to 35 million for the newly acquired assets, as we previously guided, our forecast capital spend for 2019 is expected to be in the region of 170 to 190 million. So now turning to slide 18. Over the last 2 years, we've greatly improved our access to capital while maintaining a strong balance sheet that supports our investment in growth. During 2018, we made progress in staggering the maturity date of our borrowings, and this is something we'll look to continue to optimise. In May, we refinanced £200 million of floating rate notes with 300 million of fixed rate notes. This extended the maturity profile of our debt to November 2025, and it provided protection from an increase in interest rates. When swapped back into sterling, the bonds also offer us an attractive rate of interest of around 5%. This complements the existing 4.25%, 350 million fixed rate note, which matures in 2022. We also have an RCF, which matures in April 21, with an option to extend by 1 year. It has a competitive margin, and at the year end, there was no cash drawings on that RCF. In early January, we cash settled the Scottish Power Generation acquisition, and we only drew 550 million of the 725 million facility. This 19-month facility provides additional flexibility over the timing of refinance, and it's competitively priced. Our expectation is that we will refinance all or part of this through 2019. Our strong credit rating allows cheaper access to credit. It's supportive of our trading strategy, and it remains robust to low points in the commodity cycle. So moving on to slide 19 to look at capital allocation. We're committed to making disciplined capital allocation decisions, and we think about the approach in 4 stages. Firstly, maintenance of a strong balance sheet, and that's defined as being a target net debt to EBITDA of around 2 times. Secondly, a continued investment in the core business to deliver our strategy. Thirdly, a sustainable and growing dividend. The 15% increase on a per-share basis in 2018 is consistent with this objective. The precise level of growth will vary year to year, depending on the operating environment and investment needs of the business. Finally, a consideration of a wide range of development projects across the group. These offer attractive returns, but could require significant future investment. These investments are subject to external factors such as the capacity market, but also the demonstration of a strong investment case. Turning to slide 20 to look at the capacity market assumptions. As Will has already noted, we expect that the capacity market will be re-established during 2019 with retrospective payments for the period since suspension. Capacity payments for the generation business, including the newly acquired assets, are expected to be £68 million in 2019. 42 million of this spans the 9 months of the current capacity period, and 26 spans the 3 months of the next one, which begins in October. As part of the acquisition of Scottish Power Generation, we agreed a risk-sharing mechanism with Iberdrola, which could provide compensation of up to 26 million in the event that capacity payments for the current period are not received and a gross profit floor is passed. In this scenario, while the net cash impact of no capacity payments would be 42 million, the risk-sharing mechanism will be treated as an adjustment to purchase price, and as such, the EBITDA impact would be the full 68 million. Until the capacity market has formally restarted, we'll continue to defer revenue recognition in the generation business and continue to recognise all the costs in energy supply. In the event that the market's not re-established, we'd expect there to be some offsetting benefit associated with lower energy supply costs. To be clear, our adjusted EBITDA expectations for 2019 are based on normal operation of the capacity market. And finally, moving on to slide 21 and summing up. In 2019, we expect to deliver an increasing level of stable earnings and to further strengthen our balance sheet. The acquisition of Scottish Power Generation accelerates this progress, and it adds a high-quality, multi-site, multi-technology portfolio where 2/3 of its earnings are from non-commodity exposed sources. Added to this, we have index-linked renewable revenues, we have long-term biomass procurement contracts, and we have a rolling 5-year FX hedging program, all of which provide a growing and predictable level of base EBITDA, subject, of course, to maintaining high levels of operational performance. This is further enhanced by expected growth in our pellet production business. In terms of our major options for development of new gas, significant investments would be underpinned by index-linked capacity agreements, and so would further enhance this earnings visibility. This is all a very different proposition from the group's heritage as a single-site, carbon-intensive power generator. With that, I'll hand back to Will.
So thank you, Andy. So what I thought I'd do is just give you a quick update on some of the strategic initiatives that we're working on. So again, in the context here, it's all about delivering our purpose of enabling a zero-carbon, lower-cost energy future. We believe this is one where there will be an increasing demand for electricity, as I mentioned already, and ultimately a world in which the sort of system support piece where we will deliver would be 15 to 25% of the overall marketplace. Right? I guess the points I wanted to make here is really that we see opportunities really across of our business to helping to deliver the vision, right? Whether it's in biomass, where effectively if we can make this viable without subsidy, we think there's a long-term role in supporting the system with low-carbon generation, whether it's across our generation business as a whole. Again, there's an opportunity for us to make additional investments to support the system with low-carbon power going forward, or whether it's in our supply business, right? Where by giving control to our customers, we can allow them, again, to help participate through demand-side response, for example, in supporting the energy system in the UK. Let me talk a little bit more about sort of biomass and how we see that sort of playing a role in the overall system. So the first point really that's important is that biomass effectively is a key and low-carbon source of system support, right? Effectively allows system support at with low carbon intensity, which effectively you can do with hydro, but other than that, it's pretty much the best way to do that, right? Again, as I mentioned before, gas will ultimately be part of the picture, but biomass, we think, is an important piece of it as well in the long term, right? The second thing about biomass, which is very important, is the way that it supports forest growth, right? Effectively, by providing additional earnings for forest owners, that they have been reinvesting. Effectively, they're enabling forests to grow. So the forest cover in the southeast of the U.S., just by way of example, has increased very substantially, let's say since the 1950s, as a result of further investments in those forests enabled by sort of an attractive and successful sort of forest economy. And the final point is really around BECCS, which is the opportunity to do sort of bioenergy carbon capture and storage. And let me just tell you where sort of we are in this whole sort of process of doing carbon capture. So we have effectively started a trial where we're capturing a ton of CO2 per day. The purpose of the trial is twofold. One is to effectively prove the technology as it is working now, and that is working very successfully. And the other thing is to start enabling us to understand what the economics of effectively carbon capture would be sort of at the power station at scale. Right? So obviously there's a very different proposition to be capturing 10 million tons of CO2 a year as opposed to that 1 ton of CO2 per day. And that's really, we would hope to have significant progress on both of those fronts by the end of the year. Right? The second key thing that needs to happen, or we expect to happen in 2019, is really the government has set out a task force whose objective is to actually establish a regulatory framework to enable carbon capture. Right? So effectively, again, if you think about carbon capture, there's really three pieces of the puzzle. There's capturing it, which is what we're working on. Then there's the transport, and then there's the storage or the usage of it, right? And effectively, there needs to be a regulatory framework in place to allow that whole thing to work and allow that whole system to be economically viable, right? So again, we're working with the government on that to effectively make sure that actually, well, we will not make any significant investments until that system is in place. Yeah. Second key piece of sort of strategy I wanted to update you on is the biomass sort of optimization and cost reduction, right? And effectively the different places where this is ultimately coming from, right? So the first thing that we're focused very much on is how can we reduce the cost of the pellets that we're actually producing? Remember today that's about 20% of our usage is from our own pellets. We have a target of growing that to 30%, and ultimately that may grow further over time, right? And there's multiple ways in which we're reducing costs. So one is by reducing feedstock costs, which is primarily about using more effectively sawmill residues, sawdust, as opposed to thinnings coming out of the forest. And again, an example of what we're doing there is the co-location of the Hunt Forest Products sawmill next to our pellet plant in LaSalle. Right? That's happened. They are actually up and running and actually producing lumber and actually giving us residues. Right? And so that's a very attractive, low-cost source of feedstock for the LaSalle plant. Second thing is about reducing process and transport costs. And again, a good example of that is the LaSalle rail spur. So by basically connecting LaSalle to the rail network in the southeast of the U.S. and not trucking the pellets to Baton Rouge, we end up with a significantly lower cost of transport. And again, as Andy mentioned, roughly speaking, a third of the overall cost of a delivered pellet is in the transport. So this has a significant benefit, reducing the cost per ton by as much as $10, right? The third area we're looking at is how can we be more efficient in terms of overall plant performance. This is both in our pellet plants, but also at the power station. So one of the investments we're making is in a turbine upgrade in our biomass plants in the power station that effectively will improve our thermal efficiency and effectively get us more bang for our buck for each pellet that we use. And then the final piece is really using new technologies and new feedstocks. Right? So this ranges from the more proximate, i.e. things that we're investigating quite actively now, like using bagasse or sugarcane residue and actually making pellets from that as a very low-cost feedstock. Again, that's one thing that we're looking at right now. So that could widen, what we call here, widening the fuel envelope. Second thing we're looking at is more sort of technology-driven solutions, like extracting sugars from the wood. Those sugars ultimately can be used for liquid fuels, for example, and effectively reduces significantly the net cost of the fiber that we actually would use to make pellets. That's a more long-term thing. And just in passing, I think it's worth mentioning, Andy mentioned the benefits of the patent box. For those of you familiar with that, effectively that is a lower tax in the UK on anything that you have, which is earnings that are delivered by your own registered intellectual property. Right? So Drax has a very strong history of delivering technological innovation, and actually having that recognized, I think, is quite a significant point. So lots of things happening there. And again, we plan to have a capital markets day later in the year where we'll continue to update you on our progress on cost reductions. So what I've laid out on the page here is the various different investment opportunities that we're looking at across the business. And really what I wanted to do is not get into any of them in more detail, because I think we've been through these with you all in the past, but to just talk through a little bit how we think about sort of each of the different sort of areas here. Right? So the first thing, the important thing, is we look at the opportunities in the round, meaning that we are, as we think about allocating capital, it's really across the whole portfolio. Right? There isn't sort of a business unit specific piece. It's, all of the different investments are compared to each other to find the best returns ultimately for shareholders. Right? Second point I would make is that we absolutely believe that the UK will need new gas generation. Right? And obviously with the challenges for new nuclear, we think that is even more true than it has been. Right? So again, the capacity market has not cleared at attractive prices in the past. The capacity market needs to be reinstated. We believe that will happen. But ultimately, we do believe that that will provide a price signal for investing in new gas in the UK. Right? Third point, I think, is by adding Dam Head Creek 2 as another project. For those of you who are not familiar with it, effectively we have a site next to Dam Head Creek, which is effectively in the Thames estuary, sort of in Essex. Effectively, we have a site and a project that's sort of permitted and ready to go for a power station, again, around, I think it's 1.6 gigawatts power station that's pretty much ready, 1.8, apologies, 1.8 gigawatts, and is pretty much ready to go. So we're working on getting that ready for the capacity market. Right? And as you know, we think that our repowering is a very attractive project because of the benefits of using some of our existing infrastructure at the power station up in Yorkshire. Dam Head Creek 2 has other benefits, which is that locationally, because it's very close to London, it's got significant economic advantages for that reason. Right? Fundamentally, then, the next thing I would say, just the last two projects. So Cruachan 2 is a project that Scottish Power was working on effectively to expand, or there are multiple different options for expanding the pump storage up in Scotland. And the final one is BECCS, which I've talked about. I mean, both of those, I would say, have the same characteristic that they're quite a bit further away, and they both require, I think, the right regulatory framework in order for them to be gotten off the ground. So I would think of those as longer-term options for us. So in wrapping up, as I think about 2019, so there's a lot of things we're doing. We are in the power generation business. We're looking at integrating Scottish Power and making sure that we keep our availability high as it has been. In the B2B retail business, it's about continuing to grow our attractive sort of gross margin, continuing to drive the cost base, and ultimately delivering the systems that will underpin our future strategy. And then in our pellet production business, it's about producing as many low-cost pellets as we can, and also continuing to investigate options for both lowering costs and further increasing our capacity. But beyond that, we are working to keep our investment options live, and there's work going on to develop those further. And ultimately, we need to deliver results for our shareholders. Final point is that in terms of our capital allocation, number one objective for 2019 is to get our balance sheet back to where it was, i.e. getting back to that 2.0 net debt to EBITDA target, which, again, we would expect to happen, assuming the capacity market does return. And again, having done that, we'll continue to look at our new investment options and make sure we balance appropriately the right mix of business growth and cash returns for our shareholders. So with that, why don't we go to any questions that people might have? Chris?
Oh, good morning, Chris Labert. Chris Labert, JP Morgan. Firstly, just on the dividend, when can we expect, I guess, the next update? It also seems that you've got more growth through your P&L and cash flow and a balance sheet constraint. Will that be a consideration in the middle of the year? And if you give some sense for where you are at the moment, if you can. Secondly, I mean, you've made it quite clear that this year is about getting the balance sheet down to that targeted level. Does that mean that M&A is off the table if you came across a terrific opportunity would you still look at it? And is the pipeline deep? And what's in the pipeline at the moment that you're seeing coming to you? And in terms of retail, that 2025 target, which you presented at last year's Capital Markets Day, I guess this is a question for you, JK. How confident are you of still reaching that target, and what are the moving parts that get us there?
Okay, so on the dividend, I think the approach that we will take this year will be the same as we've taken in prior years. I mean, we will come back to you at the half year and give you a sense of where we think the underlying dividend will be, and anything beyond that we would discuss at the end of the year. Right? But again, I think probably the key factors that will go into that, obviously we need to make sure that we integrate and deliver the Scottish Power acquisition as we expect to, and we also need to have more visibility on where the capacity market comes out. Right? On M&A, I would say, fundamentally, we're very much focused on getting the balance sheet in the right place. So that's definitely the number one priority for this year. So that's what I would say there. And then on retail?
Yeah, so if you look at the underlying gross margin of the business, we're pretty happy with the growth that we've delivered in the past year. A further percentage on our market share and that delivery of that gross margin. That is against the sort of, I suppose, the headwinds of three major fundamental things with weather, this unidentified gas, and this rock mutualisation, and that's about 5 million. Equally, we've done some good work in stabilising our bad debt position and obviously improve the balance sheet there as well. So underlying, we're very happy and pleased with the performance and with that continued growth. And we definitely see that growth coming because there are some fairly heavy stresses on the larger players. Some of the newer players coming in are struggling financially. And so we see it as a real opportunity to continue that growth, which we've done for the last 3 years now. And then these new systems that we're putting in place, we can already see the benefits in the early parts of the development of these systems, that they're going to become a lot more efficient. And so we're going to be able to process more customers through these systems at significantly lower cost than we're actually holding today. So we're very confident, and we'll talk about it again in the Capital Markets Day later in the year, that we can still deliver on those targets that we set out.
Great. Thanks, JK.
It's Ian Turner from Exane. Can I just ask just 3 questions? Firstly, how you would stack up Damhead Creek 2 against repowering one of the units at Drax main site, because obviously they're the same size, and how the economics of those we can compare. Secondly, there's a lovely photograph at the front of your pack of the Cruachan Reservoir. I wondered if you'd given any consideration to raising the dam, which I think is something that was done at De Norwich a few years ago. You look at the picture, there's obviously room for a few more metres on there. And then thirdly, there's been some comment in the press about a consulting contract between Drax and Lord Deben, who's the chairman of the Climate Change Committee, they've been doing a lot of work on biomass. I just wondered if you had a comment on that, and perhaps, I don't know, the new finance director, chance to have a look at that with internal audit. I don't know whether you've got any comments on that.
So why don't I take the last one? I think the key thing about that sort of consulting contract there, we've followed the processes as we should be. I'm confident that the Climate Change Committee has done the same. So I think the work we've done with them is nothing to do with climate change. So I think that we've done all the things as we should have done for that. Right? Maybe Andy, do you want to take the other two?
So in terms of Damhead Creek versus repower, I think this is a decision we need to make later in the year, and certainly going into the next capacity contract. I think the key things for us on Damhead Creek 2 is getting an idea on CapEx. So I think Will talked about the fact that there are more favourable transmission charges down in the south compared to around Drax. But what we need is a full sort of CapEx cost for that, and that needs to be refreshed. So we're going to do that over the course of the year. And repower is all about getting our planning and also getting a firm figure around the CapEx there. So I think over the course of the year, and certainly coming into the capacity market, which hopefully will be back for next February, that's when we need to look at the decision. But we have opportunities and choices, which is really good. The second point about raising the dam, as Will said, there are a range of options that we can look at Cruachan. These are long-term projects, and certainly raising the dam is a high CapEx option, and that's certainly at the extreme end. There's upgrading the turbines that we already have, and there's a range of options there. And I think the key for us is getting the right regulatory support and the right framework in order to do that. So we have environmental studies that Scottish Power had already delivered. The key for us is what could be that regulatory framework to deliver a large-scale CapEx project over a number of years, and then we can really firm up the options that we have at the plant there.
Could you please comment upon the performance of the share price of Drax?
Could I comment on the performance of the share? I'm not sure that I can, to be honest. I mean, it is what it is, I guess, yeah.
So what is the reason that the market has given a very low price target for the share? It's not much higher than the current share price. The market, the stockbroker, the company's broker.
I guess the way I think about that is that Drax is a business which fundamentally is a very long-term business, right? We have assets that we would expect to run through the 2030s. We're going to be making investment decisions that also will have implications through the 2030s. So for me, I'm very much focused, and my team, we're very much focused on two things. We're very much focused, one, on making sure that as we operate and run the business, that we deliver exactly what we need to deliver, right? So we make our plants available as much as they can be, that we actually can, we deliver for our customers as much as we can be. So that's every day in year, that's fundamentally what we do, right? The other thing that we do is we have to make sure that we actually make the right decisions long-term for what is in the benefit of all of our shareholders, right? If we do those two things and we do them as best we possibly can, then the share price will take care of itself.
Thank you.
Hi, it's Alex Wheeler, RBC. 3 questions from me, please. First of all, are you planning to update the market on 2025 EBITDA targets at the CMD? Secondly, how should we think about outages post-2019? And finally, on the retail side, do you think that Ofgem's review of micro businesses will have any impact on Drax's retail business? Thank you.
Okay, yeah. So I'll take the first one, and then maybe Andy the second, and JK the third. So I think in terms of the 2025 targets, I think there's a couple of things that we already know. I think JK has talked about the retail targets. I think in terms of our pellet plants, I mean, the objective of getting to 30% self-supply continues to be the same. I think that we have some of our ambitions about bringing pellet costs down are probably new relative to those original targets. Clearly, the Scottish Power acquisition is new, so and then also I think, if you remember back, we actually had not announced the ideas of repowering at the time when we actually set those targets, right? So I think the answer is we will sort of come back to Capital Markets Day probably in the fall. I'm not sure we've set a date yet, and we'll frankly just talk about our strategy and how we see those various things developing over time. Yeah. Andy, do you want to talk about outages?
Yeah, so on outages, we have 2 biomass outages this year on units 2 and 4. Going forward, there should be 1 biomass outage every year. So 2021 is the CFD outage, and then 1 per year after that. In terms of coal, we did an outage on Unit 6 last year. It was a very sort of low maintenance outage and really reflecting the running regime on coal now. And clearly that will also be impacted by whether we proceed with our repowering plans at the plant. So Unit 6 was last year. I think the next coal ones are 2020 and 2021, but they're likely to be much lower scale. The biomass ones are the key ones in the future.
Yeah, and then on the sort of Ofgem's investigation, we welcome it, because any review on competition for the UK's largest challenger brand has got to be a good thing. The CMA review they did a couple of years back, we'll definitely be recommending to Ofgem to look at that, see if some of the remedies that were put in place have served what they needed to, which we believe they have. But fundamentally, any review into competition is a good thing for a challenger brand, and we'd also welcome a review in the TPI market as well, the third-party intermediaries who serve a lot of the customers.
Great. Yeah. Sorry. Yep.
McLaren from Merrill's. Good morning.
Yeah. Sorry.
Just two questions, please. You mentioned the reduction in the cost of the pellets at your own plants. Can I just check where the benefit appears within the group, please?
Yep.
And secondly, electricity prices are rather lower now than when you agreed the Scottish Power deal. To what extent does that impact on the acquisition case and the outlook for earnings from those plants?
In terms of the cost of pellets, effectively the transfer price is set, so any reduction in the cost would come through the EBITDA of the pellet business. Yeah. In terms of the power prices, I mean, frankly, I would say the new news since we've sort of owned the assets, I would say that they are performing very much as we would have hoped they would in terms of being there for system support. I mean, some very sort of good results in that areas so far. And power prices, I would say, they will go up, they will go down. I wouldn't say there's been any change in the acquisition case because of that. Yeah.
Hi, it's Dominic Nash, Barclays. A couple of questions from me, please. Firstly, on your bad debt, I think you mentioned this in your presentation from consumers. Could you give us a sort of feel for what the % defaults you are seeing and whether this is increasing or staying constant? And is that a feel for the general market or Drax specific? And secondly, could you just sort of talk me through this on cash flows on the capacity payments to retail as well, please? Are you currently pricing into your customers this sort of £3 a megawatt hour-ish capacity payment? What are you doing with that cash, and is that sitting on your net debt number to be handed back, or what are you going to be doing with it?
Andy, do you want to take the bad debt piece and then the cash flow? Yeah.
Yep. I'll answer the second question first. I mean, so we're receiving the cash, collecting it from the customers. We have accrued all the costs to be able to pass that on, so it goes over to the generation side. As I said, we haven't accrued the revenue on the generation side. We're actually in a relatively unusual position in that we have a balance there because we have the revenue on the generation and the cost on the retail side. And actually, whilst it doesn't balance completely, there's a reasonable good symmetry there.
It's about 60 million, I think, isn't it, over a full year, something like that?
Yep, at the end of the fourth quarter, there was a 7 million impact, so that's the revenue that wasn't accrued in generation, and again, an almost offsetting amount on the retail side.
So I mean, just to add to that as well, which has been interesting feedback, is obviously the larger payments of the capacity market sit with the larger customers, which are generally on pass-through contracts. And they have all been very clear and expecting that to be recovered. So their expectation is the capacity market will come back, and hence we're working with them accordingly. And then obviously there's many contracts that are on fixed price as well, so that they are on fixed price contracts, and obviously we just continue to collect on those. On the sort of debt itself, in terms of when you look at the actual breakdown of the debt, sort of 3 million of it is because we're looking at a full year on Opus. 2 million of it is because we've got a much larger revenue now, so that those two take account. And then within the Haven book, we've finished now a 3-year piece of work on debt, which we've now cleared all of debt post 365. So the actual increase in terms of debt is around about 5 year on year. And what we're seeing is there are increases in insolvencies on the high street. Very much in Haven, that is not affected because it's mainly larger businesses. Within Opus, about sort of 50% of our book is micro businesses, and probably sort of 20-30% of that is within the retail part. So we are putting in processes to manage that, and obviously keep a very close eye on that. And that's what the work that Andy spoke about in the second half has been about, making sure that we're focusing on markets that we can feel confident we can collect debt from.
So it's worth just noting on that in the 31 million expense for the year, we added 16 million of additional provisions, which I noted are on the balance sheet at the end of the year. So whilst it's too early to call success on our bad debt, I think we're in a better position than we were when we started the year, and with all the other activities we've done, we're confident that we're well placed as we exit the year.
So sorry, at the risk of sounding sort of cheeky here, just the actual amount of cash sitting on your balance sheet that you're going to hand back on capacity markets, if it were to be reinstated on a retrospective basis, is how much?
I'm not sure I know that number exactly, so I'll get back to you on that one.
Thank you.
If it were to be reinstated, so if it were to be reinstated, actually, we would have a net benefit. Right?
Okay, if it wasn't to be reinstated, sorry.
If it wasn't reinstated, it's a smaller amount than the amount that actually, I mean, than the amount that we would benefit if it were reinstated. If that makes sense. Anyway, let's take it offline. Anything else? Yeah.
Adam Prasad from Cantor Fitzgerald. Just sort of follow up on the capacity market. You seem to be signalling that you think a similar outcome might be likely. Are you actually now ruling out sort of more dramatic changes to the capacity market, using the disruption as an excuse?
I guess I wouldn't be in a position to rule out a different outcome, but I think that our understanding is that the government's, the path that they would like to go down, as we understand it, is one which is quite similar to where it has been. Yeah. Someone, Chris? Yeah.
Good morning, Chris Labour, JP Morgan. How comfortable are you with consensus for 2019 at the moment?
Andy?
Yep. So we published a consensus last week, and I would note that consensus has 406 million of EBITDA. I'd also note that there's a number of varying assumptions in there when it comes to the capacity market. I would also worth noting that the commodity price assumptions vary in a range also. So we'd note the 406, and I think you can make your own conclusions from that.
Anything else? All right, well, thanks everyone for coming. We will be here if you have more questions, and thanks again for coming.